With the PSCI hitting beyond 7,400, you see all your investments glowing green, especially for those that started during the pandemic when our market was below 6,000. During those times, we plan out so much when our investments aren't doing good. But investing in the stock market, we experience these cycles when markets go down and up, hitting all-time lows and highs. So it's not only during bad times when we plan out and be careful about what we are investing in, but especially as well during when markets are bullish. For me, these are the times when you really have to be careful. So in this video, I'll talk about what I'm doing and my strategy when my stocks are hitting all-time highs. First off, the most important is stop and think first before you buy. I know it's so exciting to see your portfolio glow green from all those positive gains you're getting, seeing your money increase day to day, and you want to buy in even more because you feel like you will be left behind if you don't invest now. But before you do, stop and think first. Do not let your emotions decide what your next move will be. So for you to prevent yourself from letting emotions take control of you, first off, review your checklist. Does it pass your checklist? Are you buying it below your buy price? If not, then that's all there is to it. Move on to the next undervalued stock in your watch list. Usually before I buy, I always make sure to update my buy price for the companies in my watch list. For example, they posted higher earnings for the quarter, then I'll update it as my formula inputs the earnings of the company. As I said a while ago, we have these market cycles of all-time highs and lows, so no one knows if the market will continue to go up continuously or if it will go down again. So the best thing you can do is be patient and continuously buy the undervalued stocks on your watch list. If there's no longer any company that trades below your buy price, then just wait or look for another opportunity. There's always an undervalued stock out there. That's why this is the only problem when markets are bullish. It gets harder to find good bargains. So to cut things short, before you press that buy button, run through your checklist first. If it passes, then go buy it. If not, then move on to the next stock or patiently wait. Second, let your winners run. This is so important. As I said, before buying, I always make sure that it is trading below my buy price. The same before I sell a stock. I see to it that the stock is really overvalued. What does the price ratios tell me? Or has it gone past my computed fair value? All of this I make sure, because some investors, when they see some gains in their portfolio, just go sell the stock to lock in profits. Then after, the stock just keeps continuing to go up again and again. Because it doesn't mean the stock went up, it's already overpriced. You have to look at how well is the company growing. Is the PE ratio still low? Some companies have grown so well that they kept a low PE because their earnings caught up to its price. Second, what is your goal for that stock? For me, some companies I bought at a very cheap price that the dividend yield I'm getting from those companies far exceeds 15%. This way, I'm just going to hold it for a very long time and get those chunky dividends, and I always reassess those companies if their earnings are stable and growing. This way, I know it has a very high chance that they would increase as well their dividends. Third, I see to it as well to recompute my fair value of the company, especially if the quarterly or annual earnings have been released. This way, if the company has grown, the fair value would also go up. This way, I get to see if the stocks are truly trading at a very high price in relation to its fair value. By the way, if you don't know how to compute the intrinsic value of the company, then you can watch my video of it in the description below. So always, as I said, reassess first before you buy. Likewise, before you sell, reassess first if the stock is really overvalued. To conclude all of it, what do the price ratios tell you? The PE ratio, the price to book, is it overvalued compared to its peers? Has it gone past your computed fair value? That's why it is so important before you even buy that stock, you have an entry plan and an exit plan, so that if it hits any of those, you would know what to do. Now before moving on, if you're finding it hard to get all these data to analyze a company, its financials and price ratios, then there is a solution for you, which is simply Wall Street. The way they present their data is so easy to understand. They show you graphs, comparisons, and give out explanations to better understand it. They also have a watch list so that you will stay updated about the stocks in your portfolio or the stocks you're monitoring when they release their earnings, dividends when insiders are buying or selling, and when the stock is trading below its fair value. Yes, they also compute that for you. And my favorite is the portfolio tracker. This way, I get to see the health and performance of my portfolio, and there's more in store for you. So if you want to try it out, they offer their basic plan forever free. And if you want to sign up to get unlimited access to all the tools and data, then use my link below to get up to 50% discount. Thank you, and back to the video. Third, don't get too attached to your stocks. I know in investing, favoritism and emotions are a common factor for a lot of investors that influence their investing decisions. That's why to control this, always be guided by your checklist. I know I've repeated the checklist over and over again in this video, but it is what will prevent you from having these biases. If the stock is overvalued, then it's time to think of selling it, or you can half slice a stock to at least take away your initial investment from that stock and reinvest it into another undervalued stock in your portfolio or watch list. Likewise, if the stock is beyond your buy price, don't get too biased about it because it's your favorite company and force yourself to invest in it. Let's just learn from the index itself. For a long period, index investing beats most expert investment managers. Why? Because the index just passively invests in the largest company in the country automatically. It doesn't get attached to its stocks. If one stock fails to meet the criteria, it removes it, and if one passes, adds it. It continuously does this passively every month for a long period, without any biases and emotions to decide for it, and it has been so successful doing it. Apply this to your strategy of just actively and passively following it, no matter what the market is doing, up or down, you just continue your strategy. Fourth, reassess your goals. Now before you even start investing in stocks, you need to have your goals in place. Like for me, my goal is to be able to retire off of my dividends. That's why my strategy revolves around the concept of investing in great companies. These are companies that have consistent earnings growth, consistent equity growth, meaning their assets grow more than their liabilities. A company that manages its debts well, because yes, debts can help a company grow, but if not managed well, it can be a hindrance to its future growth. Next is, the company should be paying consistent dividends, so a great company that pays consistent dividends, because if the company's financials are good, the higher chance their dividends would be stable and would grow over the years. And lastly, I should be paying the right price, so I just consistently invest in these kinds of companies. A strong company, paying consistent dividends, bought at a reasonable price. And this also dictates whether I'll be selling that stock as well. If I'm getting good dividends from it already and I see the company is growing consistently, then I'll think about if it's worth just holding that stock even though it is way beyond my fair value. So having a goal can help guide you no matter what the market is doing. And it's better to have a path to follow than just randomly investing without knowing where you're going. This step is often skipped by a lot of investors, but this is one if not the most important step to have. Having a goal also lets you stay in the game for a long time. It helps you stay patient and consistent. So these are the things that I follow, may it be the market is going down or hitting all-time highs. I see to it that I'm loyal and consistent with my strategy. I see to it I'm updated with my companies to reassess my projections and computations for the company when earnings are released. I see to it that everything I do is in line with my end goal of retiring off of my dividends. These simple things will help you stay calm no matter what the market is doing. It lets you stay in the path toward your end goal and of course, make your investing journey easy and stress-free. With that said, I hope you've learned something from this video, and if it did and still haven't clicked the like button, then I'd appreciate it if you do so before leaving. And if you haven't signed up to Simply Wall Street, what are you waiting for? Try it now. It will really help you along the way. Thank you and see you in the next video.